Right, away from corporate news, let's look at some of the economic data coming in today. The Eurozone core inflation figures, of course, out. What do the numbers say about the region's largest economies like Germany and France, and of course the laggards like Italy and Greece?
You're right, exactly. Inflation in the Eurozone was pretty much in line with forecasts. Now, it fell to 1.4%, even though the core inflation, excluding more volatile prices like the price of food and energy, actually showed an underlying uptick of 1.1%. So what this means for the Eurozone, at least in general, is that the prevailing narrative of inflation being slow to pick up is going to prevail for some more months, and that would mean that the European Central Bank will stick to its strategy of removing stimulus only at a very slow rate. So this very slow pickup in inflation, as I said, is expected to persist even as GDP growth among the countries remains steady and strong, with differences between the markets you mentioned, Germany, France, Greece, and Italy, even as these differences between the GDP growth slowly become smaller. Now, several things are at play here, of course, just like the strong euro. As we know, a strong euro tends to make imports cheaper and depresses prices. And this is a phenomenon that is occurring in all of those countries, again, that you mentioned. There has been not a quick enough uptick in inflation in Germany, in Italy, in France, and in Greece.
Right, thank you very much for those updates, General. We'll continue to keep a tab on your market. Enjoy the rest of the day. We'll move on to the U.S., where stock index futures pointed to a higher open today, bouncing back from yesterday's weak trading session as investors switched focus to a huge batch of data and corporate earnings. A number of major brands are set to publish earnings, including Walmart, Best Buy, Viacom, Best Incorporated, Manchester United, Splunk, Williams, Sonoma, Gap, and Applied Materials. Alongside earnings, a flood of economic data is set to be published. First up, jobless claims, import and export prices, the Philadelphia Fed's manufacturing survey, and the business leaders survey are all due at 8:30 a.m. Eastern Time. At 9:15 a.m., industrial production is due, followed by the NAHB Wells Fargo's Housing Market Index, set to come out at 10 a.m. Eastern Time. Elsewhere, the future of a tax reform deal in the U.S. is expected to add uncertainty to markets throughout the trading day, as investors remain on edge over whether a reform will take place during 2017. House Republicans are expected to vote on their tax reform bills today, with GOP leaders remaining confident that the bill can be passed this week, despite lingering resistance seen from some Republicans. Those futures numbers, they're all in the green. Dow Jones Industrial 0.26%, S&P 500 0.35%, and Nasdaq 0.41%. In Asia, equities shrugged off the softer lead from Wall Street to close higher on Thursday as oil eked out slight gains during Asian trade. The Nikkei 225 bounced 1.47% to snap a six-day losing streak as financials, retailers, and most tech names rose. South Korea's benchmark Kospi index tacked on 0.63%. Trading hours had been pushed back by an hour. The Australian S&P ASX 200 edged up 0.16% to close at 5,943 points, with a heavily weighted banking sub-index climbing 0.13% in the session. The positive sentiment was also mirrored in Greater China markets. The Hang Seng Index rose 0.67%. On the mainland, the Shanghai Composite reversed early gains to close 0.08% lower, and the Shenzhen Composite rose 0.23%. Away from the markets and to other markets news, but here in Africa, Kenya Airways has finished restructuring $2 billion of debts, completing a key part of its turnaround plan after heavy losses. The airline's top shareholder, the Kenyan government, and 11 local lenders converted the bulk of their debts into shares, helping to relieve cash flow pressure. That figure includes full commitments to financiers and operating aircraft leasing companies, which are not normally reflected in the balance sheet. As part of its assistance to the company's revival efforts, the government also offered contingent guarantees for $750 million of the airline's debt for 10 years. Kenya Airways, which is part owned by Air France KLM, posted the country's biggest ever annual corporate loss of 26 billion shillings in its 2016 financial year, hit by a slump in travel and high financing costs after buying new Boeing planes. The losses pushed the company into negative equity of 45 billion shillings in its financial year to the end of March. And Mediclinic International PLC, South Africa's largest private hospital group, has reported an 11% drop in underlying profit in the first half of the year, hurt by weaknesses in its Middle East and Switzerland businesses. The company, which owns stakes in Britain's Spire Healthcare and Switzerland's Has London, says underlying earnings fell to £84 million for the 6 months ended September 30 from £94 million a year ago. Mediclinic, which expanded into the United Arab Emirates with the acquisition of Al Noor in 2015, says revenue in its Middle East business fell 5% to 1.48 billion dirhams. The group's total revenue rose 10% to 1.41 billion pounds. The Al Noor deal helped it double its exposure to the UAE, but has been hurting its operating performance due to the new health insurance regulations in the region. And the International Monetary Fund expects the Angolan economy to grow 1.1% this year as sub-Saharan Africa's third largest economy enjoys a mild recovery. The International Monetary Fund said this following the visit to the country where Richard Veloso, the Brazilian economist who led a 10-day visit to that country, says macroeconomic imbalances remain and that needs to be tackled by the new government. He highlighted the widespread between the parallel and official market exchange rates and the backlog of foreign exchange purchase requests in commercial banks as points of continuing concern. We'll take a quick break now, and when we return, of course, we'll look at the commodities issues. To stay with us.